All right, let's talk about a company the market has totally gotten wrong. And you know, when the market gets something this wrong, there's usually a huge opportunity hiding right under our noses. Let's dive in.
Okay, let me ask you something. Have you ever missed a stock? I mean, really missed it. You looked at it, thought, nah, too boring, and then bam, 6 months later, it's tripled. We've all been there, right? It's that gut punch feeling. And it's a classic trap, especially when a business is changing in ways you just can't see on the surface.
So this company, Glottis Ltd, its IPO was kind of a flop. It listed below its issue price, and yeah, you guessed it, most investors just bolted. But here's the thing. What if that wasn't a red flag? What if that initial drop was actually a gift? What if the market's looking backward, completely missing the fact that this company is building something entirely new?
So, first things first, we have to completely change how we think about this business. Forget everything you assume about logistics. We've got to see Glottis for what it really is. It's an orchestrator. It is not a trucking company.
And that right there, that's the core idea. The market looks at Glottis and sees, a simple middleman, someone just moving boxes. But the reality is so much more complex, so much smarter. They're not just getting something from A to B. They're managing the entire messy, complicated dance of global trade. We're talking ships, planes, and trucks.
So what does that even mean, orchestrator? We'll think of it like this. Glottis is the conductor of a giant orchestra. It doesn't own the instruments. The violins, the cellos, those are the ships, the planes, the trucks. What Glottis owns is the sheet music and the expertise to make all those different instruments play together perfectly. This is an asset-light model, and that's the secret sauce. It's what lets them scale up and get a really high return on capital employed, or ROCE. It's all about how much profit they squeeze out of the money they have.
And they build this whole thing one client at a time, piece by piece. Look, a new customer doesn't just show up and hand over their entire global supply chain. No way. It always starts small, maybe just one shipping route as a test. Glottis nails it, trust starts to build, then it's 2 routes, then it's customs brokerage, then maybe warehousing, and before the client even realizes it, Glottis isn't just another vendor, it's become their outsourced logistics brain. And that is how you build relationships that are almost impossible to break.
Okay, so the business model is clever, right? But the real question is, are they actually making any money? Let's get into the financials, because the numbers here tell a really interesting story. It's a story about a company hitting a major turning point, learning how to turn all that operational chaos into actual cash.
Wow, okay. First thing you see is the revenue growth. It nearly doubled in 1 year. We're talking 500 crores to 940 crores. And look, this isn't just some one-off fluke. This is a sign that their platform is really starting to hit its stride. It tells you that big clients are signing on, and maybe even more importantly, the clients they already have are trusting them with more and more of their business. This is what trust looks like on a spreadsheet.
Now, you might look at a 9% EBITDA margin and think, that's not that great, especially if you're used to software companies. But you have to understand, in the brutal, low-margin world of freight forwarding, competitors are lucky to get 2 to 4%. A stable 9% margin is absolute gold. It screams pricing discipline. It tells you they're not just chasing growth at any cost, they are being smart about it. And that's the bedrock of real sustainable profit.
Okay, and this next point is maybe the most important one. This is the one that separates the serious players from the wannabes. See, in this industry, it's super easy to show a profit on paper, while you're actually just burning through cash. But with Glottis, we're starting to see something beautiful. Their operating cash flow is finally beginning to track the reported profit. That is the single clearest sign that they've cracked the code on turning their complex operations into real money in the bank.
So, who's in charge here? It's the founders. They still own 74% of the company. Think about that. For them, this isn't just some job. It's their entire life's work. That high promoter holding means their skin is fully in the game. Their goals are perfectly aligned with long-term investors like us, not with chasing some short-term stock pop. When you own that much, every single decision you make is personal.
All right, so if this is such a good business, what stops someone else from just coming in and copying it? What's the moat? Well, in logistics, the moats are tricky. They're not the kind of thing you can see on a balance sheet. They're invisible. But they build a fortress around the business that's incredibly tough to break down. The real moat, the secret weapon, is what you could call process memory. Think about it. Once Glottis is deep inside a client's day-to-day operations, handling all their customs paperwork, knowing their exact shipping quirks, finding the best routes for them, switching to a new provider becomes a massive headache. It's expensive, it's risky, it's just plain painful. Glottis literally becomes part of the client's muscle memory.
And that's a moat you can't just buy or build overnight.
Okay, let's just stop here for a second because this is so important. Most people think logistics is about moving boxes. The smart money knows it's about controlling decisions. The value isn't in the truck or the ship, it's in owning the entire information layer that sits on top of it. This is the exact playbook of global giants like C.H. Robinson. They don't own thousands of trucks. They own the data, the process, and the relationships. That's where the real money is.
Now, of course, it's not all sunshine and roses. There are risks. Freight rates go crazy sometimes. A global recession would obviously hurt shipping volumes. But here's how we should think about these. They aren't deal breakers. They're execution checkpoints. The company is already building in resilience by diversifying its routes, services, and customers. Honestly, overcoming these kinds of challenges is exactly what makes the business tougher and smarter in the long run.
So, the big question, what's a business like this actually worth? You can't value it by counting its assets, because that's not its game. You have to value the things you can't see. The sticky customer relationships, the predictable cash flow, the ability to grow without spending a ton of money. And right now, if you look at the stock price, it feels like the market is pretty skeptical about all of that.
So if we run the numbers and look at a few different scenarios, a pretty interesting picture emerges. In our base case, if they just keep doing what they're doing, the stock looks, well, fairly priced. In an optimistic, upside case, there's a lot of potential for growth. But here's the kicker, and this is what I love to see, the downside case. Even if things go a bit wrong and growth slows down, the business is still solid and profitable. This tells me the risk of a total wipeout is pretty low.
So what has to happen for the stock to move? What's the catalyst here? It's really simple, actually. The market just needs to open its eyes. It needs to stop seeing Glottis as just another freight broker and start valuing it for what it is, a deeply integrated, highly scalable logistics platform. That's the mental shift we're waiting for.
And this brings us to that awkward phase. You know, the one that's usually the most uncomfortable, but also the most profitable. It's that period after the IPO hype dies down when the company is still finding its feet. This is exactly the moment when impatient people get bored and sell. And it's also the exact moment when patient, long-term investors start quietly buying.
Okay, let's bring it all home. Let's tie all these pieces together. What is the actual investment thesis here? What's the big story, and how do we think about this company's journey from being invisible to becoming indispensable?
Look, this is not an all-in, bet-the-house kind of stock. Not right now. This is a story you enter in stages. You might start with a small discovery position, and you watch. You watch the execution. As you see the proof, as the cash flow starts to line up with the profits, as those margins stay strong, you can add a little more capital. Your conviction grows as the company proves itself step by step.
So what are the key things to keep an eye on? I don't even think of these as risk factors. They're more like compounding markers. First, watch that gap between cash from operations and EBITDA. That's the sign they're turning trust into cash. Second, are they getting more business from their existing clients? That shows the relationship is deepening. And third, are those margins holding up? That's your signal for pricing power. These three things will tell you everything you need to know.
So, here's the bottom line. Glottis is not a perfect company. It's something way more interesting. It's a business that is figuring out in real time how to take the complete chaos of global logistics and turn it into predictable, high-quality value. For any investor who has the patience to be early, this is a story that you absolutely have to watch.
And I'll leave you with this one last thought. Every great logistics franchise starts out invisible. They just work quietly, deep in the background, becoming more and more essential over time, until one day you realize the entire system can't run without them. All the signs are pointing to the fact that Glottis is walking that exact path right now.